Hello, everyone, and welcome to Live with Jim and Anna. It's the second Friday of the month, and we're ready to listen to your questions and answer them. Anna, are you there?
I am there. Hi, everyone. Hey, Jim, what's going on with the hat? Where did you get it?
Well, Anna, I'm in doing two reunions this week. Yesterday, I had a military reunion with the disc jockeys from my Korea days. And so we had a big meeting in Las Vegas, and I drove over this morning to Canoga Park, California, where I'm celebrating our 50th high school reunion, and it's the 100th anniversary of our high school. It's a homecoming tonight, playing our arch rivals, Reseda, and I'm in a parade and everything, so I thought I would wear my hat identifying me as retired Air Force Major.
That is too cool. I like that. I like that, Jim. I know you have a closet load of hats, so.
Well, this is another one I bought, so.
Good.
It's getting fuller. Anyway, let's get to the questions.
Okay.
Can I ask you a question first of all?
Yeah, we can start. Go ahead.
Okay. Well, the first question is a really interesting one. It says, I noticed that my investment portfolio that Jim helped me design, according to Mint, is underperforming the market, and Mint is mint.com, which tracks people's investments, as defined by the S&P 500, the NASDAQ, and the Dow Jones. Is that bad or normal? It seems to be getting worse lately. Do I need to rebalance?
Yes, that's a good question. We have gotten a couple of similar questions about or comments from clients in the last week as the market is doing bad, the market is doing bad. Well, so the first thing to think about is let's define what is the benchmark of your portfolio. That way we can actually make a rational comparison of what how it's performing. So for example, if you have a portfolio that is 60% invested in stocks and 40% invested in bonds, then S&P 500, NASDAQ, or Dow Jones are not good benchmark for that portfolio. And the reason is because S&P 500, Dow Jones, and NASDAQ are all 100% stocks. So we're really comparing oranges to apples. In order for us to get a really good assessment of what that 60-40 portfolio I mentioned earlier does, we need to come up with a custom benchmark that has 60% invested in stocks and 40% allocated for fixed income, such as bonds and cash, to give us a really true, accurate picture. So hearing something in the news or watching sites like mint.com will give you an idea what the market does, but it's not quite what the portfolio that we have designed for you is performing. So yes, you do need to rebalance, and our tradition is to recommend to our clients at least to come see us once every 12 months. Actually, we have a number of clients who come back quarterly or every 6 months. But looking at what Mint is telling you or listening to the news and worrying about what the market does and whether it is underperforming the story. Any additional thoughts on this, Jim?
Well, when people are looking at their account balances and it's down from last week or last month, they have to ask themselves a couple of more questions. Is it down from last year, a year ago? And do I need any money out of that portfolio? Because, Anna, you know, we both recommend 2 to 3 years worth of cash for people that need to make withdrawals, our bucket one strategy.
Yes.
So therefore, they don't have to worry about the market going up and down because it's always going to go up and down.
Right, right. But also, I really would like to reshift the focus of the market being defined by S&P 500 and the kinds of portfolios that our clients have. Unless they have all stocks, sure, that's a good benchmark, right? You can be cheering up or not cheering up every day when you hear the market report. By the way, actually, what we did earlier this week, both Jim and I, if you follow us on Twitter or you get Jim's tweet summary, we tweeted a market report that one of the bloggers that both Jim and I like and follow, it's the white coat investor. So he does a market report update every month. So if you take a look at that, you'll actually be surprised that the market is not doing all that bad as what you actually hear on the news. So
right, he uses a portfolio with about 15 different slices of the pie, using mostly Vanguard index funds, and so you can see 1 month and year to date. And most of the portfolios we're looking at these days, people that have 5 or 6 or 7 different slices of the investment pie are up probably anywhere from 4 to 6 to 7%.
exactly. So that's not as bad as it seems. Okay. Well, let's move on to the next question. Okay, so this one is for you, Jim. Okay, several months ago, you gave me a recommendation to roll over my old 401k and invest it in a target date fund inside a rollover. Does that advice still hold?
Well, Anna, if you recall our agreement, our advice is in the here and now, and it doesn't always last forever. In fact, that's one of the reasons that we like to rebalance people once, twice, 4 times a year, depending on their needs. But this was a single young man who 26 years old, and so I told him the short answer is yes, it still holds, because I had recommended Vanguard Target Retirement 2050. And that kind of a portfolio is 90% in the stock market, both U.S. and international, and 10% in U.S. bonds and foreign bonds. So that asset allocation is going to hold probably for the next 20 years or so, and then start to get slowly more conservative. So even though the stock market has changed somewhat in the last 6 months, he's making a 40-year decision, and that's what I told him. And I told him to expect a real return, which is the total return minus his inflation of expenses. It should be 5 or 6% over that long period of time, and that's a wonderful expected return. So compounding will take place, and he'll end up with a nice amount of money for retirement, even if he never adds anything to it for that specific account.
Right, and his time frame is just several months ago. I also agree that that's a totally still valid recommendation. Okay, very good.
Well, you ready for a second question, Anna?
I'm ready. Let's do it.
This comes from one of our clients who said, I haven't put money aside for the mutual funds and exchange-traded funds as you suggested. Do you recommend waiting to do that given the market? I don't want to put money in and lose it.
Same question as just the first one we discussed. Again, this idea of the market isn't doing that well, and a lot of times what we say is just turn off the news channel and don't read the newspaper in the morning. It's funny how even this morning, getting ready for work, my husband Yuri had on his computer some news channel going on, and I said, why are you listening to the market report? And he says, oh, there's a lot of volatility going on, and I just wanted to know. And he says, aren't you interested? And I just shook my head and went on to get ready. So just because there's something going on today isn't going to change our lifetime plan. So that was my first thought. But again, I want to refer back to that market report that we tweeted a few days ago. And the question in your mind should be, or give you a good comparison to think about whether to invest and take the advice that we had given you is, how about when there's a sale going on at the grocery store or at the mall? What do most consumers store or to the mall, and we stack up on various items, whether we need them or not. So if there's sale going on, then we buy. So why not implement the same strategy with your investments? So if you see that supposedly the market is down, that should be an indicator to you that maybe it's a good opportunity to buy low. As Warren Buffett suggests, we should be buying low and selling high. But when we look at consumer behavior, it actually happens to be the opposite. So we tend to buy when the market is, we tend to sell at the wrong time and buy at the wrong time. So just keep that in mind, and waiting again for some time to take our advice. It may not be the same strategy unless we recommended one of those target funds. I think Jim has one of, I think you should add a comment where a few years back when we were watching, where you thought I was watching the market for you on the bad days and you were buying a few mutual funds. You wanna comment on that?
Well, Anna, in the old days, I thought was watching the market, and she would comment sometime during the day, "Oh, Jim, the market's doing bad today." I said, "How bad is it?" She said, "Oh, it's down 1%. I said, "It's not bad enough." So a few days later, she said, "Oh, Jim, the market's down 3%. I said, "Great." So I went to all my accounts, any kind of cash I had. I bought an S&P 500 index fund, knowing that in time it would go up, and I wanted to buy low. And I even considered, but I didn't do it, taking a cash advance on my credit card
Oh
to
no.
put money in the market. I didn't do it, but I thought about it because I want to take advantage of bad days. I like to buy on really bad days because the market as a whole is up 2.5 days up to 1 day down. So it goes up and down, up and down. But on really bad days, I want to put more cash in. I don't know when the bottom of the market is, and for probably 5 or 6 months, I kept buying, and the things I bought went down. But when they came back up much faster than if I hadn't bought anything at all. In fact, this year, emerging markets and international stocks have been down, and so when I saw that part of the pie in my portfolio shrinking, that's where I've been putting my money. So I've been trying to practice what we preach, Anna, which is
Right.
buy low, sell high.
Right, but I want to go back to this question for just a second, because the question started out as if I haven't put any basically I haven't implemented the advice that you had given me. So it kind of concerns me, because if this person hasn't done anything we had recommended, so what is going on, or how is the portfolio invested at the moment, and is that gonna affect them even more? Given that the market might be going down or going up. So it's not just about taking our advice and implementing what we're recommending, but also reassessing of where you are currently and thinking whether that's going to be the best place to stay. So I just want to kind of stress that a little bit.
Cool.
Okay. Do you want to add something?
No, that's good.
Oh, okay. All right, great. Well, let's shift our focus a little bit into a different area of personal finance. I think we beat the market a little bit today. But a second question for you, Jim, is this. Is whole life insurance a good retirement investment?
You know, that's an interesting question, and that was asked by a reporter to me the other day. And I responded back to that question by saying, you know, whole life insurance was created to last a person's whole life, and we call it permanent insurance. So term insurance is kind of temporary for some period of time, and whole life, along with some other kinds of insurance that I won't talk about right now, are classified as permanent insurance, and they last their whole life. I'll tell you what, in my personal case, is my pension dies with me, so I have whole life insurance, because if I die before my wife, then I want her to get the life insurance proceeds no matter how old I am, and there's no survivor benefit for my pension, so we need life insurance that lasts a whole lifetime. Also, whole life insurance, along with some other permanent life insurance, pay dividends, and sometimes those dividends can be bigger than the monthly or annual premium. And so a couple of my whole life policies are now having the premiums paid by the dividends. Now, whole life insurance can be used for other purposes, like retirement, but there's kind of mixed results. What you need to do with the whole life policy is overfund it. That means putting in a lot more money than the normal premium. There are limits on that, because the IRS says if you put too much money in and it compounds without paying taxes, then we don't want you to do too much of that. So there's limits on how much money you can put inside a whole life policy, but you're basically these days getting about a 3% return without paying any taxes on it. And when you die, your beneficiary gets the money income tax free. Income tax free. For people who have net worth in multiple millions of dollars, there might be some other consequences, but for most people, the beneficiary gets the death benefit income tax free. Now you can take loans against an overfunded whole life insurance policy and borrow the money back out, as long as you don't borrow everything out and collapse it. If you collapse it, then there are tax ramifications. You pay income tax on anything over the basic premiums that you paid, and it's not taxed at capital gains rates, it's taxed at ordinary income rates, which for many people is a larger percentage. Also, when you borrow money from your life insurance policy, you pay interest to the insurance company. So that isn't always the most effective way, even though you may not have to make the loan payments back. You're expecting to die first. That's a heck of a way to get out of a loan, is to have to die. Anyway, I told the reporter there's also a lot of other reporters who've written stories and other advisors on why whole life insurance is not a good investment for retirement. I did point out that the people who sell these kinds of policies do spend a good time studying how to market this product, and it solves all sorts of problems, including retirement, but it also pays a handsome commission to the salesperson, since whole life is a difficult product to sell. Mm-hmm. Is that enough explanation for you, Anna?
That is enough explanation, Jim. It looks like we forgot to announce that while we're talking, there's an opportunity when you're looking at your screen, the video screen with us on it. There's on the left-hand side, there's an option to ask a question, and if there's someone who has a question, we'll hang on for maybe 30 more seconds. Maybe I can ask you one more question, Jim.
Okay.
So what have you been reading lately? I know in our profession we constantly have to stay in touch with everything and be updated. So have you read anything good lately?
Yes, and it's a fairly short article by Jonathan Clements of the Wall Street Journal. He's one of their personal finance writers. He's been with the Journal, and then he left, and now he's come back to the Journal. And the name of the article is, and I want people to just Google it because they'll find the article without a subscription, Financial Beliefs You Might Not Like. Financial Beliefs You Might Not Like. The writer is Jonathan Clements, C-L-E-M-E-N-T-S. It's got about 12 or 13 concepts or principles or issues that people should consider, and it's really concise and great advice, and I know he spent a long time synthesizing these things down. I thought it was a wonderful article, and I've been sending it to a lot of people.
Cool, very good. I already Googled it, and I'm going to read it myself and tweet it and share it with my followers. Okay, it looks like there's no questions that we can see on our chat, but we're open for more to discuss next month. I'm off to Santa Barbara for the weekend. A little pleasure, but work. So, Jim's, have a great time at your reunion, and everybody, happy Friday. And we're looking forward to catching up again next month and waiting for your questions. Okay?
Thank you, Anna.
Take care. Bye.
Bye.